After first coming across a relatively new ETF and doing some research into it, then slowly buying into it over time, I've been becoming a bigger fan of SPYI, which is the Neos S&P 500 High Income ETF. As time has moved on, I've been really pleased with the consistent high monthly dividend and the low volatility that this investment has been offering. So much so that I now consider this ETF to be my favorite monthly income-paying investment. So in this video, I'm going to go into why I've become such a big fan of this ETF. I'll talk about how this fund works and its performance up to this point. I'll also cover the pros and cons of it and what sets it apart in my opinion. While I'm at it, I'm also going to compare it to some other covered call S&P 500 funds, as well as some other alternative higher yielding investments like closed-end funds that are offering the same yields. The Neos S&P 500 High Income ETF describes itself as a fund that seeks high monthly income in a tax-efficient manner with the potential for upside appreciation in rising markets. The fund invests directly and through derivatives in stocks of companies operating across diversified sectors and uses derivatives such as options to create its portfolio. This ETF seeks to generate high income from the premiums earned from SPY call options as well as the dividends received from the fund's equity holdings. It's managed by Neos Funds, who launched SPYI or SPYI back in August of 2022. Before going further, I want to define what I consider to be specifically an income holding and what I like to look for in an income holding. In my portfolio, I blend two investing strategies, which are dividend growth investing and income investing. My dividend growth holdings provide my portfolio with consistent dividend increases and share price appreciation. But even my dividend growth holdings yield at least 4%, which is just my own personal minimum. But with my income holdings, I don't care as much about share price growth or dividend increases. What I look from these holdings most are dividend yields of 8% on the low end to 12% on the high end. I rely on these holdings for high current income, which is what I personally like to look for. I try to pick income holdings that are very sturdy in terms of share price and dividend distributions. This ETF we're going to look at today falls into the income investing category. On their website, they highlight three main features of this ETF. The first is the high monthly income, which it says, investors may seek increased income generation potential within their portfolios through options writing. SPYI has been able to provide investors with a consistent dividend yield of over 12% since its inception, which is among the best when looking at any dividend-paying ETF out there, and it pays monthly dividends, which is always better. The second feature of this fund is lower correlation. Options-based ETFs are less sensitive to market risk factors such as credit, duration, and inflation risk. SPYI is also less volatile than the overall stock market, which is great for any income-producing investment. And a high-yielding investment with share price stability is exactly what I'm personally looking for when picking an income holding. The third part, which I'll dive deeper into later, is that this ETF actually offers a more tax-advantaged dividend compared to other investments. I started buying small amounts of this ETF last year after reading about what makes them different from other covered call funds that exist. If you're not familiar, a covered call strategy is when an ETF buys the stocks in an index and then writes or sells corresponding call options on the same index. And then the premiums received from selling the call option provides the income that we as investors receive. As the ticker symbol suggests, SPYI invests in and executes its option strategy on SPY, which is the Spider S&P 500 ETF. Comparing SPY's holdings with SPYI's, you'll see that they hold the exact same companies. You get Microsoft, Apple, Nvidia, Amazon, and so forth. SPYI actually holds slightly more tech than the index, but only by a couple percentage points. Ever since Global X introduced their covered call funds many years ago now, new companies like Neos and even JP Morgan have been rolling out their own covered call ETFs. In my opinion, these new companies were observing exactly what Global X was doing with their CC funds, and they started introducing their own funds with slightly different strategies as a way of trying to outdo Global X's. I actually used to be a shareholder of Global X's S&P 500 covered call ETF, but several months ago I decided to sell all of my shares of this ETF and move it into SPYI because I believed it had the superior strategy. There's a couple ways this holding outperforms other S&P 500 covered call funds that exist in my opinion. The first is that the fund managers with this fund have more flexibility when it comes to adjusting their strategy. The Global X covered call funds are all passively managed, whereas SPYI's is actively managed. But because it is an actively managed fund, it does allow their managers to make some slight adjustments to their strategy to improve its performance depending on the market. For example, SPYI can also write covered call spreads with their ETF, which can be beneficial depending on the performance of the market. They haven't done this in a while, but just the fact that they have the option of doing this when the market presents a good opportunity, I think is a big positive. But even their approach to using covered calls is different than other covered call ETFs that exist. SPYI writes or sells call options and buys call options on the S&P 500 index. This differentiated strategy allows this ETF to gain more upside when the market is doing better. Their strategy has also resulted in SPYI being less affected than XYLD when the market takes a downturn. We'll do a side-by-side comparison of SPYI and XYLD in a little bit. But another reason why this ETF is more appealing is because it takes advantage of Section 1256 contracts. According to their website, it says, actively managed by Neos, the fund seeks to take advantage of tax loss harvesting opportunities in addition to utilizing SPX index options classified as Section 1256 contracts, which are subject to lower 60/40 tax rates. I'm not a tax expert, so I can't really attest to the impact that this would have on tax savings, but honestly this feature was like the icing on the cake for me, because even if it didn't offer any potential tax savings, I still would have found SPYI very appealing. Let's compare the features and returns of SPYI with XYLD since both ETFs write covered calls on the S&P 500 index. There's two main reasons why I prefer SPYI when compared to XYLD. First is that it does offer a much higher yield. SPYI currently yields 12.14%, whereas XYLD yields 8.84%. Second, again, SPYI just has a much better strategy. It captures more upside than XYLD and really a handful of other covered call ETFs that exist. XYLD is passively managed, so it doesn't have the kind of flexibility that the Neos ETF does. If we compare the share price of SPYI with XYLD over the last year, SPYI continues to do much better. When times are good, they're overall much better for SPYI and less so for the Global X Fund. And running both ETFs through a dividend reinvestment calculator, their one-year total returns show that SPYI has done far better overall. XYLD has done good, but it's not even close when speaking of performance. With these factors in mind, the Neos fund is just the superior choice when looking at a covered call fund for the S&P 500 in my opinion. But what about other options that exist? What about other covered call funds like JEPI and JEPQ? These are both great investments, and I do hold both of these ETFs in my portfolio. However, they don't offer the consistent high yield that SPYI has. Both ETFs have gone through pretty dramatic changes in monthly dividend distributions at times. But on the plus side, both of these ETFs do offer better share price growth. The reason I like SPYI though is because it's been a lot more sturdy. I do like having some holdings that can consistently yield over 9% or more regardless if there's any share price growth or if the share price is mostly flat. SPYI, in my opinion, is just another worthwhile addition to a high-yielding portfolio that'll go well with some other holdings that can provide growth. There are some closed-end funds that can offer yields around 12% or even more. Some of the PIMCO funds like PDI can offer yields close to this and even exceed this, but these kinds of CEFs come with more risk. Again, I think there is a reasonably good risk-reward situation with some of these, but SPYI looks like a much safer investment. To summarize, there's a lot of reasons why SPYI is my new favorite income holding. It's a diversified fund that comes with a high yield that pays monthly. Although its track record isn't too long, what we've seen so far is a lot of share price and dividend stability compared to its competitors. Plus, it does come with some tax savings, which is more beneficial. Even though it hasn't offered much share price or dividend growth up to this point, simply reinvesting all of those 12% yielding dividends back into the fund every single month is going to produce a really good dividend snowball over time. But with that being said, that's going to conclude today's video. Let me know in the comments section what you think about this ETF and if you think it's a worthwhile investment to hold. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. Plus, it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.